How can small apartment investors effectively analyze supply and demand dynamics in the rental market? Let's dive into some key strategies. First, let's review historical rental market data. Examining historical vacancy rates helps us understand how well the market absorbs rental units. Low vacancy rates indicate strong demand, while high rates suggest potential oversupply. Next, we analyze absorption rates. This tells us how quickly new rental units are leased, reflecting demand for additional inventory. High absorption rates signal strong market demand. Lastly, tracking changes in rental rates over time helps assess whether demand is pushing rates higher or if oversupply is limiting increases. Now, let's analyze factors influencing supply. Monitoring construction activity is crucial. Using data from local permitting offices or construction reports helps track new developments entering the market. High levels of new construction can signal future oversupply risks. Evaluating inventory levels by comparing the number of available units to historical averages gauges whether supply is increasing or decreasing. Additionally, assessing zoning and policy changes involves researching local regulations to identify policies that may encourage or restrict new rental development. Finally, we evaluate demand drivers. Accessing census data or local government reports helps identify areas with growing populations or demographic shifts that favor rental demand. Analyzing employment data, including job growth and major employers in the area, is essential. A strong job market typically supports rental demand. Staying informed about tenant preferences, such as demand for amenities, unit size, or specific property types, allows us to align offerings with market demand. Identify trends in supply and demand dynamics. Compare vacancy and absorption rates alongside new construction data to assess whether the market is balanced, undersupplied, or oversupplied. Look for underserved markets with strong demand and limited inventory, signaling opportunities for acquisitions or developments. Identify potential risks, such as areas with declining demand or an oversupply of units, and adjust investment strategies accordingly. Leverage tools and resources for analysis. Use reports from real estate firms, property management companies, or government agencies to access detailed data on supply-demand dynamics. Platforms like Zillow, CoStar, and Rent.com provide data on rental inventory, vacancy rates, and pricing trends. Engage with local economic development agencies for insights into population growth, job creation, and housing needs. An investor evaluating a neighborhood finds the following. The area's rental vacancy rate has consistently remained below 5%, indicating strong demand. A recently completed apartment complex reached 95% occupancy within 90 days, highlighting quick absorption of new units. Several planned developments are set to add 500 units to the market over the next 2 years. Based on this data, the investor determines that current demand supports investment due to low vacancy and high absorption rates. Future competition from new developments may impact rental rates, prompting adjustments to pricing or amenities to remain competitive. Monitoring supply and demand dynamics is critical for apartment investors to assess market conditions, identify opportunities, and mitigate risks. By analyzing factors influencing supply, such as new construction and rental inventory, alongside demand drivers like population growth and employment trends, investors can make data-driven decisions. Tools like vacancy and absorption rates provide insights into market balance, enabling small apartment investors to optimize investment timing, target high-demand markets, and align strategies with market trends. Regular analysis ensures investors stay informed and prepared to adapt to changing market dynamics.